Hey everybody, my name is Jake. Welcome to the channel. If you clicked on this video, you're probably interested in investing in dividends. You may have watched one of my videos in the past. If you're new, welcome. I'd invite you to subscribe if you're interested in the concept of dividend investing or dividend growth investing. That is what I talk about in every single video. I'm really talking or addressing newer or beginner investors, and I like sharing things that I've learned on my journey to financial freedom through dividend growth investing. And that's what this channel is all about. It's sharing with all of you what is working, what is not working in terms of this strategy. And in today's video, I want to talk about 4 different things that I've learned in 2019 as a dividend growth investor. For those of you that have followed the channel, you know that I've not always been investing purely into dividend in this dividend growth model, but rather I've tried many different things. And in 2019, it was really an interesting year. And in 2019, I started this channel. We're up to almost 1,000 subscribers. Thank you all so much for your support. I really appreciate it. In today's video, I want to really break it down as if I were talking to a new investor or someone that is interested in starting to invest in a dividend growth strategy, right? That's who the video is for. That's what I'm going to be sharing today. So if that's what you're interested in, let's get right into it. So the very first thing that I learned in 2019, there were a lot of ups and downs. As you can see in my portfolio here on the screen, this is M1 Finance. I've been investing here in M1 Finance since the middle of May. So not very long. Back in the middle of May, what I did was I transferred over my portfolio from Robinhood into M1 Finance. It was very simple. All I had to do was send them an email and they transferred it for me. It was completely free. It was really easy. And so what I did was then I transferred it all over and I set up daily transfers. I can show all of you very easily here. I set up daily transfers to go into the brokerage. And the way that M1 Finance works is it automatically invests into your holdings, into your slices of your pie. This is my overall pie. These are my individual slices. In the individual slices are individual companies, and in some small cases, individual ETFs. I do own a few ETFs in this portfolio. And what I've done is I've dollar cost averaged into the market. And I've done that since the middle of May. Now, I can sit here and say, oh, well, I wish I would have done this since 2009. This is not something that I've done since 2009. And to be quite frank, since 2009, I've been following the market steadily, and I've just always thought, okay, well, it's now at a high. I'm just going to wait for the next drop. I can still remember saying I'm going to wait for the next drop back in 2010. That is, if historically, since 2009, you could have said that every single month, pretty much, almost. That, oh, okay, I'll just wait until it drops again. We've been in a bull market for 11 years. Back in, I think I can't show you here on this screen. What I can do is I can go into the funds here into SPY. It's an ETF that follows the S&P 500. But if you look back here towards the end of, right here, the end of 2018, I remember having a conversation with my dad around, okay, well, is that time now? Are we in that market crash? And we really thought that we were gonna have a major correction, and that the market was gonna go back down to where we were at. We were gonna re-enter a recession, but that is not what happened. What actually ended up happening is the market jumped up about 30%. So that is the first thing that I learned in 2019. And now that's easy to say, yeah, I learned that because the market went up 30%. But what I've been doing over the last couple of years in my 401k and my Roth IRA is dollar cost averaging into my investments. Right? And so every 2 weeks, from my employer, I then invest into my 401k, for example. And what I've done in my M1 Finance account here is every single day I'm depositing money every single week. And these deposits have varied depending on the situation that I'm in my life. For those of you that follow the channel, I recently purchased a rental property, so I dialed back my weekly investments from $300 down to like $50, and then I've ramped it back up again. So I've always been investing into the market. And I think a lot of you may or may not have heard this, but it really matters more about time in the market than timing the market. And that's the strategy or the approach that I've taken in 2019. And it is so, so important for me specifically because in the past, I've really struggled with managing my emotions. When I was trading on margins back in 2007, it was a scary time. I still remember to this day when I was investing with money that I did not have. It was not my money, it was borrowed money. And so it was like high stakes poker, but it really did not fit for me as an individual. And what I slowly learned was, I value being able to sleep at night much more than that potential 5 or 10% extra gain that I may get, but it's also on the reverse side that I also may lose. So this has really helped me. This is the first thing that I've learned in 2019 is the value of dollar cost averaging. And I've actually shared another video on this on my channel. I'll link in the top right if you're interested in just solely the topic of dollar cost averaging. I'll link up in the top right. The second thing that I've learned in 2019 is surrounding yourself with positive people. Let me give you an example. When I tell people, for example, at work or my family, mostly at work, and those that I associate myself with, that I'm investing in this strategy and this approach, that like a lot of people that I'm working with are in their younger, earlier 20s, and I say, yeah, I'm investing into McDonald's, into Procter and Gamble, Kimberly-Clark, Union Pacific, Waste Management, all these pretty blue chip industrial U.S. companies. A lot of them look at me and say, why would you do that? Why wouldn't you just invest in a Bitcoin? Or why would you not just invest in a cannabis or put everything in a Tesla? Now, of those three, I think Tesla is probably the winning bet there. But what I'm getting at is a lot of people, as you start to pursue this path in dividend investing, a lot of people are going to ask you why. Why are you doing that? Or some people I might even say, okay, that's stupid, right? In terms of their perception of investing, everyone has a different opinion. Everyone is in a different situation in their lives, and whatever it may be. And so that is the second thing that I've learned is, you don't want people around you that are always going to agree with you. You're not going to grow that way. But you want people to be supportive. You want people to understand why you're doing something, instead of immediately discouraging you from something that may actually be beneficial or helpful for you. And so that is the second thing that I've learned here in 2019 as I have embarked into this dividend growth strategy. The third thing that I want to share with everybody that I've learned in 2019 as a dividend investor is really avoiding the yield trap. Now, I've fallen prey of that as well, where I've seen an individual stock and I've thought, okay, wow, this is a great deal. This is amazing. I'm going to get rich, right? All of that good stuff because it has a 7% dividend yield. Let me give you an example. CenturyLink. Early in 2019, in my Robinhood account, before I moved over to M1 Finance, I invested into CenturyLink. And at the time when I invested was shortly before they cut their dividend. Right after they cut their dividend, the yield got cut in half, over half, over 53%. Right now, they still have a really strong dividend yield. But as a dividend growth investor, I want to invest in a company that is continually growing and they're growing their dividend. So in 2019, I fell prey of it. I learned, everyone makes mistakes. This is something that I've learned in 2019. In my portfolio, when you go over to I can show you, really, really easy here. When you go into the overall portfolio, you can actually see the the overall dividend yield, for my entire portfolio of 93 holdings, I have an average dividend yield of 2.5. This is the current yield. This is not yield on cost, what I actually paid for it, but this is what the investments are currently yielding. And you can also see the expense ratio, which is very, very, very small. So that's the first example with CenturyLink. I'll give you another example. Another example was the Kraft Heinz company, right? I fell trapped to this as well, right? Where it's a great company. It still is a good company. It's like in the top 5 largest food suppliers or food in that industry in the U.S., but actually in the world. So they fall in the same category of Nestle and so forth. But they still have a good yield. But when shortly after I invested into it, they cut their dividend, right? So they cut it about 36%. And so this was also another holding that I brought over from my Robinhood account. Remember when I transferred over from Robinhood to M1 Finance, I brought these holdings with me into the portfolio, and so it stuck with me. I still have Kraft Heinz in my portfolio. I have since liquidated CenturyLink from my portfolio. There are very few times that I will sell a stock, and that is one of them. When a company cuts their dividend, that is when I separate ties from the company. I really am a buy and hold investor, and that's something that I've learned in 2019. So be very, very careful of the yield trap. That is something that I've learned. The fourth thing that I've learned here in 2019, and this is really a personal thing for every individual, but what I learned was you have to understand your why. Why are you doing it? Why are you investing? And there's so many different strategies when it comes to investing. And I think the more traditional strategy that most people agree with or the most people follow is the 4% rule. Most people are investing in their 401ks or investing in general so that they can, once they reach retirement, they can liquidate a small percentage of their overall portfolio every single year, and that amount is what they will live on. That's what is called the 4% rule. And in theory, what it's supposed to mean is by the time you reach retirement, you're 65 years old, let's say you have $1 million in your portfolio, you're going to liquidate 4% every year, sell 4%, and the goal is that the money outlives you, right? So that your money lasts longer than you do. So that is the whole 4% rule. And as a dividend growth investor, what I'm trying to do is I'm focusing on the earned dividends. I'm not looking to liquidate or sell off my shares in retirement. I'm looking to live off of the passive income, right? And that's what you can see here is, in the earned dividends in my portfolio, this is what I'm focusing on. I'm not focusing on the market gains. I'm focusing on the earned dividends. In the last week alone, we've gotten over $23 in earned dividends. I mean, this is what I'm striving for. I'm striving so that one day, I'm not nearing retirement today. It's going to take me a little while, but one day the goal is that I can pay for all of my living expenses with earned dividends. That's the goal, and that is my why. My why is it's so that I am financially free. I can then live off of my passive income or my cash flow in the portfolio that's going to then pay for my living expenses. And this concept of reaching financial independence, it's not so that you can just be lazy and do nothing. It's so that you get to decide what you do with your time. I know a lot of people that are financially independent, but they still are active. They still have other things that they pursue, their hobbies, their passions, right? And then for me, understanding my why, once I really understood, okay, why am I doing this? It made it actually really exciting. So if you're a new investor or a beginner investor and you're really starting to learn about dividend investing, is this something that an approach that you want to pursue? You have to understand why you're doing it. Because this compounding effect, this snowball effect, will not take place over 1 year. It's a long-term play, right? That's why a lot of people nowadays don't understand. Well, why don't you just invest everything into Bitcoin or Tesla? And that's why a lot of people are focusing on that, whereas a dividend growth strategy, it takes a little bit more patience, and you have to fund your account. And that's exactly how I have it set up, where I'm transferring money over every single day, whether it be in my real estate portfolio or in my cash flow portfolio. The cash flow portfolio is my main portfolio. You can see here, it's pretty cool with M1 Finance, is you can have multiple sub-accounts. In my main portfolio, this is really where I focus on. And in my real estate portfolio, it's set up very, very similarly based off of sectors within the real estate space. So that's how I have it set up. And no different, where I'm in here and I am investing every single day. And you can see the dividends are very minimal, right? Sometimes 27 cents, sometimes 55 cents. But this is what gets that compounding started. And then these dividends are then used to purchase other shares of other companies. For example, if you go in and you see this dividend from the UHT, you can see, all right, well, of those dividends plus my transfer of $20, for example, funded and purchased these shares. And that's what I absolutely love about M1 Finance. What's a little bit different than when you buy a stock, a drip stock where it just reinvests into the individual stock, like most portfolios or most brokerages. With M1 Finance, it leverages those dividends of all your holdings and then funds all of your underweight positions in your portfolio. The underweight positions are based off of your target allocation. So you can set it up similarly this way. You can use another brokerage. You can use Robinhood. You can use TD Ameritrade. I've historically just used TD Ameritrade and E-Trade and Scottrade, for example. And I've switched over to Robinhood back in beginning of last year, actually 2017, and then recently last year, middle of last year, I transferred over to M1 Finance. And that's how I have it set up. And the cool thing about M1 Finance is they do have a referral program, which is amazing. I set my wife up with this. What you do is, and it'll actually fund your account. So when you refer somebody to join with M1 Finance, you'll get, in this case, they have a promotion going on in January. You'll get $20. And the cool thing is, because I referred you over, M1 Finance will actually give the referrer $20 as well. So if you use my referral link, get the $20. That's amazing. It's one way that you can support the channel. I'm not monetized or anything like that. That's really the only way that I see that any support comes from my efforts here on YouTube and sharing my journey. But that's something that you can do. And if you like it, what you can do is you can then share a referral link with your family members or your friends so that you can then get that if you would like. Kind of sounds like I don't want to make it sound like a Ponzi scheme or a pyramid scheme by any means, but it's just kind of cool what you could do, for example. But yeah, I mean, it's free money. So that is how I have that set up. Going back over to the cash flow portfolio, you can see that it's $27,800, but in my actual account right here, it's only $26,800, and that is because one of my holdings is going through a rename, and that those shares were taken out temporarily and then will be put back into the account under a new name. So that's kind of the reason why you can see the dip there. I've gotten some questions on that. But once the rename is complete, that will then bounce back up to the original value, and you'll see that tick up here. So I'm hoping by the next time my next video, that'll be complete. So everybody, those are the 4 things that I learned in 2019. Don't wait to invest. The importance of dollar cost averaging, surrounding yourself with positive people. The third thing being, avoid the yield trap. If you're looking to invest into dividends, don't just look at the dividend yield. Really try to understand why is the dividend so high and see if it would be a good investment. And then the last thing, understanding your why. Why are you investing? If you're investing so that you can live off of the passive income through the dividends, then understand, why you do it. I shared a video earlier last year, one of my first videos here on YouTube, so the quality is not the best, but the quality of the video but the content is, in my opinion, really good. It's called Creating FU Money. FU Money, if you're interested in that, I'll leave a link in the top right. You can go check that video out. But once again, everybody, thank you so much for all of you that have supported the channel. We're almost at 1,000 subscribers. Thank you so much. I really appreciate all the positive, feedback that I've gotten. I know that my videos are not always the flashiest. When I watch videos from like Andre Jix, I always get jealous because I just am not a video editing guru like he is, but I hope that the content is helpful. Really, I'm addressing newer or beginner investors that are interested in investing in a dividend growth strategy. So with that, everybody, thank you so much. I really appreciate the support. If you found this video helpful, I invite you to subscribe, hit the like button, and I'll catch everybody in the next video.